Hello and welcome to Financial Statement Analysis. This is the Chapter 1 lecture. Chapter 1, we're going to talk about just an overview of financial statement analysis. And the discussion here is going to focus in just on trying to get you to understand a little bit about the concepts of what's going to get covered in this class. Uh, who are they? One of the first things you want to look at is we prepare financial statements, organizations prepare financial statements for certain types of users. Essentially, those users are going to be both internal and external, but for the most part, what we're going to focus in on is, in this particular class, is externally available information in the core financial statements. The balance sheet, income statement, statement of retained earnings, and statement of cash flows. There's businesses outside of the groups use financial statements to evaluate both the prospects and the risks of a particular business. They do business analysis on them. And you notice here you have both internal and external people that are going to use the financial statements to evaluate the business. Remember, the financial statements are a scorecard for a business. And what you have is you have different decision makers are going to decide whether or not to invest in a business. For example, when you have, say, equity investors, that would be stock people. Creditors are going to be people that are going to basically extend trade credit. We'll talk about that a little bit more. Managers within the business, they're keen to that in many cases, what's in the financial statements, because their bonus may be affected by the profitability of the business. In other words, the score that's presented on the financial statements. They might look at something called return on invested capital. People that are interested in buying a business may want to look at the financial statements to determine whether or not they're going to buy a business. And they can look at those both externally available. And once they get very serious about buying a business, they're going to look at internal. And they're going to look at the details of the business, including that maybe the operating facilities and what kind of money they're making in different regions of the country. And more often than not, it's going to be an acquisition that's probably going to, it could be both a horizontal or vertical acquisition. But either of those two acquisitions are going to, they need to look at the details of the business to determine how the potential acquired business or the potential merger are going to fit with the business. External auditors, of course, they provide an opinion on the financial statements. Directors of the business and what the business is doing from a director perspective. Those are going to be the board of directors. Regulators, that's going to be the SEC, and they determine what they have to provide. And that's going to be also a 10Q and a 10K. And the last two are really different ones. Employees and unions. Unions in particular might want to look at the financial statements of a business to determine what they might want to do in contract negotiations. And the last one are lawyers, and lawyers are just basically lawyers. Um, what do they use the financial statements for? What do each one of the groups use the financial statements for? They use it for a whole host of different things. Let's start with labor negotiations. If unions see that a company is making a significant amount of money, they may go back and say, well, we need to renegotiate our contract, or we maybe need to negotiate our contract. Let's talk about a couple other ones. Mergers and acquisitions. Well, the mergers and acquisitions, which I touched on a little bit earlier, businesses are trying to determine whether or not a business fits with another business. And remember, what they're looking at the financial statements, they're only looking at what's externally available, not what's internal to the business. So they are looking at the financial statements on the surface to determine whether or not they want to try and acquire another business or merge. Credit analysis and equity analysis go hand in hand. Credit analysis is really looking at the credit worthiness of a business. If we put this in terms of us as individuals, we kind of do a financial statement when we go to take out a mortgage loan for our homes. Equity analysis, on the other hand, is going to be something that looks at if an individual is going to try and buy stock in a business, they want to determine whether or not they're going to get a return on their investment. And really, if you look at the majority of these, not all, but the majority of these really are used to determine whether the business, the financial statements, accurately present the value of the business, and also whether somebody wants to invest in the business. The ones you might take exception to that might be the regulation, director oversight, and external auditing. but each one of them, the whole idea of a set of financial statements is to fairly represent the value of the business and the direction of the business. What are the two major reasons for evaluating financial statements? The first one is to determine credit value, and there's really two types of credit value. There's trade credit and non-trade credit. We'll talk about that in a minute. And the intrinsic value, what is the value of the business, either from an acquisition perspective or a purchase of a stock perspective? Those are two different ways you're going to look at the value of the business. First, from a credit analysis perspective, creditors, like I said, are going to be broken down into two different categories. Trade creditors are going to be the ones that are really going to give you short-term trade. Basically, it's maybe you're buying, you're a merchandiser and you're buying clothing to turn around and resell. Well, typically when you have trade credit, you're going to buy stuff and turn around and resell it within, say, 30 days. So they want to know if you have the short-term liquidity and the money to be able to pay your bills on a monthly basis. Whereas non-trade creditors, by contrast, are going to be companies that really don't worry about what happens monthly. They're looking at much more long-term stuff. So that might be where they would sell bonds. So let's go back and talk about these from a personal perspective. It helps. Trade creditors might be your credit card company, making certain that you have creditability to pay your credit cards every single month, or at least make the minimum payments every month. Whereas non-trade creditors might be people that they're going to lend you money for a house, a longer term horizon. So each one is important, but for different reasons. So that's a big thing. One more thing about non-trade creditors that I think is interesting. Non-trade creditors are a little bit different than what we would think from a personal perspective. If we go out and buy a home, you would hope that the expectation would be that you would pay it off. You know, it's a long-term loan, somewhere between 15 and 30 years. And for non-trade creditors within a business, the big thing that you have with them is more often than not, what they're going to do is they're going to renegotiate non-trade credit when it comes due. And when they make their payments, they're only making interest payments only. When you make a mortgage payment, you're paying interest and principal together. So there's a little bit of a difference from a personal perspective what non-trade creditors are relative to a business non-trade creditors. So what they're looking for is liquidity and solvency when they do this credit analysis. Liquidity is saying, do we have enough money to pay our short-term obligations? And so one of the liquidity ratios you might look at is the current ratio, which takes the current assets divided by the current liabilities. And if the current liabilities are greater than the current assets, in other words, if the current ratio is less than 1, a business is probably going to have issues with paying their bills. It would be the same thing from a personal perspective. If you said your bills are $1,000 and your current income is $900, guess what? You're going to have an issue meeting your current obligations. So you don't want to have to pay that. You'll have an issue with that. Solvency, by contrast, is more a picture of long-term what's going to happen with the business. Long-term obligations. Are they going to be able to pay them? Are they going to generate enough business to pay stuff in the long term? Because they want to know that the business is going to be a going concern and it's going to have the capability to pay back what is owed, particularly say on a bond. So that's the big difference between the two. What type of process should a business use to determine the intrinsic value of a specific company? That's talking about what's the company worth. Well, what they're going to do is they're going to do a prospective analysis. First, they're going to look at the process to forecast future payoffs, and what they're going to look at is the business environment and strategy analysis. What is the environment that the business works under? So really, what you're talking about here is big picture. What is the business working under, and what is the strategy analysis? So let's think about an example. If you look at Sears, most people know that Sears is a company that's in trouble as we sit today. So what happens is the analysis of the business environment for Sears might say, well, geez, Sears is not doing well. The business environment, you have other companies that are similar to Sears that are doing well. But then you would say, okay, what strategy is Sears following that maybe is different than their competitors in order for them to be okay as a business. So that's the first step. It's really big picture. Then the next step is you're going to look at the accounting analysis of the business. So you're going to look not necessarily at the financial statements, but you're going to look at the notes to the financial statements that tell you a little bit about what's going on with the business. And then finally, you're going to look at financial analysis, which is looking at the financial statements. We'll touch on that a little bit more in this discussion. And then you determine intrinsic value. And my apologies if you can't see the intrinsic value part on the bottom of your screen. But basically, intrinsic value says, what is the company truly worth? And what we have is when you're doing this accounting analysis, you want to make adjustments in the financial statements to affect the economic reality of the business. And the reason you want to do that is, first, if you want to compare within the firm, you want to make certain that each year, because you're looking at what they would call horizontal and vertical analysis, each year you have to make certain that the accounting is reflective, is the same. If they've made changes in the accounting analysis, you need to incorporate those in your analysis. But then also what happens is, if you want to measure and compare against other firms around the same time, you have to do the analysis of those firms as well and make certain that you're kind of comparing an apple to an apple. You don't want to compare an apple to an orange. If you're comparing an apple to an orange, you're going to get a distorted picture of how a business is. And that's what happens. And then there's other distortions that you see in their accounting analysis. Accountants make this first one where it says manager estimation error. Well, they have things, and these are, and this, all three of these are really accounting risks. Are they doing something different? Are they making mistakes in what they're doing? Maybe they've determined that they have a contingent. In their notes to the financial statements, they've determined that they have a contingent liability, but they have not recorded it because they've looked through the rules, and it says that the accounting standards, which you see this bottom one, says there's certain criteria you're supposed to use to establish whether or not to include a litigation in the financial statements, and they may specifically exclude it. And there's rules that say you have to disclose it. There's rules that say that you have to accrue it, and based off of those rules, there may be differences. The middle one's probably the most unique one on this slide, called earnings management. Earnings management says that businesses might do things to play with their financial numbers in order for them to have a really, really good year or a really, really bad year. A simple example there. If a business says that they are going to do a write-off, if they're going to make a major change to the business, well, what's going to happen is a lot of times they'll do something called the big bath. And they'll say, well, if we're going to take a write-off, what's the difference between losing, say, $70 million and $100 million? Both of them are bad news. So let's scrub our financials and look through our financial statements and look through every single possibility of an item that we may consider writing off, and they might write it off. So what happens is their loss looks so incredibly bad in the year when they do the big bath, but in the subsequent years, they have, a lot of times they'll have accruals on their balance sheet that they will relieve once they've made estimates off of those and once they've agreed. And what will happen is that the subsequent years after a big bath, more often than not, a company will, excuse me, have fantastic years. So that's a little bit of the difference for each one of those. And what you're looking at in financial analysis is you're looking at different types of ratios. Profitability analysis, for example, looks at simple things like return on investments. What have they invested? So they look at their total assets, maybe, and they might look at the amount of return. So you take the amount of return divided by the total assets, and that's going to give you return on assets, and that's it. Profitability analysis. There's plenty of others, but that just kind of gives you an idea. Risk analysis, looking at the availability of risk and the credit worthiness of the business. Are they going to be able to meet their current obligations? We already talked about liquidity and solvency. That's one of the things you're going to look at. And then the last one on here is cash flows, analysis of cash flows. Evaluate the source and deployment of funds. In other words, where's money coming in and where's it going to? If all the money is coming in, if you think about a core statement of cash flows, it has three categories. It has operating, investing, and financing. Well, if all the money is coming in the operating section, that's fantastic. And if you have a lot that is going out and investing, that means that you're investing in the business. That's fantastic. But if you flip that and you say everything is coming in, that you have a negative cash flow in the operating section and you have a positive cash flow in the investing section, potentially the business is selling off assets in order to generate cash flow in order to operate the business. So it's really, you have to look in detail at the financial statements and kind of read a little bit in the tea leaves to understand truly what those financial statements are saying to the business. Okay, what types, what type of methods should an analyst use to determine the intrinsic value of a specific company? In other words, what's the company worth? Well, they're going to do an evaluation of the business, and they're trying to determine what's the intrinsic value. In other words, what should the stock be valued at? And it's really driven by the concept of the time value of money, the present value of money. And okay, what are the various business activities that an analyst should consider? Well, you have investing, planning, and financial activities. Each one of these are operating activities for the business that feed into what they're doing. Where are they investing their money? How are they trying to grow their business relative to what you've already learned about the business environment that the business is working in? What kind of planning activities are they doing? What's their forward thought, maybe on systems, on staffing, and that sort of thing? And what types of financial activities are they doing? How are they financing that? Are they doing stock? Are they doing bonds? Each one of those makes a difference, because if they do bond financing, if you're already a shareholder and they typically will do bond financing as opposed to stock financing, the value of your stock is going to go up, because as they issue more and more shares of stock, the value of your stock gets diluted. So those are all things that happen, but they all drive into this operating activities section. And what you're really doing there is you're looking at how are they generating revenues and what are the expenses for providing either a good or a service for the business. So that's what all of these activities drive towards, is operating activities. And are they doing things to, you know, enhance the operating activities of the business, or are they going the reverse? So if you were to look at, say, for example, look at Kohl's, they're obviously continuing to grow, if any of you guys are familiar with Kohl's. And if you look at Sears, it's the reverse. And you can actually do that almost by walk around. If you, I would challenge you today to go, if you have a Sears close to you and a Kohl's close to you, go into one store and then go into the other and look at the difference between the two. Now, they don't compare exactly, but they're pretty close. They're both major clothing retailers, and Sears has the garden center and some of the other stuff. But they're very close to the same. Or maybe you look at Sears and now J.C. Penney's. And J.C. Penney's is starting to go into the breach as far as selling appliances. They had never done that, but they're starting to sell appliances. So they're kind of comparable. But if you walk from one to the other, you can get a pretty good idea of what the difference is between the two of them, and if one business is growing or not, just by walking into a store. And that's something you can understand that might be part of your analysis. So what are they doing for business activities? Just some of the stuff we talked about. But in addition, I would say business activities and analyzing, looking at their activities, but just sometimes it's just walk around by optics and looking at them. If you're trying to analyze a business, and typically you can't do that a whole lot, but if there's certain things that are readily available in your market area, you can go take a look at them, and you have a pretty good sense about what's going on. For example, you're looking at market demands and competition, and if there's things that are going to impact the business, and sometimes these business activities you're going to see in press releases about what the business is going to do. That will tell you and give you an idea of where they're going as a business. And one that's really not on here, but I think it's just as important, is stability in the upper management. Presuming that the business is doing well, there should be a stability in upper management, not the reverse. So business activities, you have two different types of financing. You have either owner, and what it has in here parentheses, equity, which is really stock, and it can be common stock or preferred stock, and non-owner is going to be liabilities. And typically you would look at that as a bond issuance or something like that. Those are financing activities. Investing activities, buying resources and selling resources. Buying resources would be like facilities or plants, not stuff that's operating, but stuff that has a longer useful life. If you were a trucking company, for example, and you bought a second truck, or you bought 100 trucks that you already had 100, that would be buying resources to enhance the business. And what we talked about earlier, if you have continual sell-off in this investing category and you have a positive cash flow, that's probably not a good thing for your business. And selling resources would be the reverse. Selling assets that could potentially generate revenue for the business is not a good thing. So if you're an oil and gas company and you're continually selling off resources in order to have a positive cash flow long term, that is not a good business proposition. What type available to utilize to do analysis? Well, you have you can break the data down into two categories: quantitative and qualitative. Quantitative is stuff that you're going to see on the financial statements, for example. Quantitative, for those of you that struggle with this a little bit, because I did, quantitative are numbers. Qualitative are just facts and data that really don't have numbers associated with them. So let's start first with the quantitative. You have financial statement analysis, industry statistics, how the business operates, economic indicators, that sometimes economic indicators will determine what's going to happen with the business, regulatory findings. One of the things that just came out recently is that they're going to, if you work for a company or you work with a company or you're analyzing a company that makes hand sanitizer, the FDA said that they're going to pull the approval to use a certain amount of hand sanitizer. The bottom one on the quantitative is trade reports. Trade reports are things that you just understand about the business. So all of those, there's numbers associated with it in some form or fashion. Qualitative stuff, the first one is this management discussion and analysis. When you pull up an annual report and you look at the management discussion and analysis, it's going to tell you a little bit about what's going on with the business, what they anticipate, what's in their financial statements, what happened in the last year. They're going to give you an idea what they anticipate happening. And that's what happens also in the chairperson's letter. He's going to talk a little bit more about what's going on in the business. And there's press releases that relate to the business. Then you also have the financial pressers, people that are called analysts that review businesses, and they specifically focus in on industry sector. And you might try and find out who the analyst is for your particular business or sector. And then they have the vision and mission statement and also the company website. And I'm not going to go into those. I think you understand a little bit about the vision and mission statement. There's 4 financial statements that are used. And I don't like the order they have these presented here because typically I put them in the order that they're generated. The income statement, statement of shareholders' equity or statement of retained earnings, the balance sheet, and the statement of cash flows. Each one of them tells a different picture or paints a picture and allows you to analyze what's happening with the business. And of course, we already touched on some of this stuff, the management discussion and analysis and the management report. The auditor report really tells you if the financial statements are good and what's in them, and if they're stated accurately. What they're going to do is they're going to state an opinion about the financial statements. And then one of the key things, and one of the more interesting things, and I'll put the pointer on this, is if you get a 10Q or a 10K from a business, is the explanatory notes to the financial statements. That'll tell you, for example, if they're using LIFO or FIFO for inventory, what their bad debt number is as far as their bad debt reserves and how they calculate it, among other things. And it gives you notes to what's in the financial statements and how a business calculates it. That's kind of a little bit of an insight into what they're really doing within the company. And that's a critical thing to look at. And then some other supplementary information, and then the proxy statement, like who's voting for who. The balance sheet, I don't know that I have to spend a lot of time on the balance sheet, but here's just a simple consolidated balance sheet for Colgate, which is also available in your book. You can kind of look through it. And the most interesting thing about this is, I know you guys are all master's students, but the most interesting thing about this is it's not really that complex. It's when you start looking at the notes that it becomes much more complex to understand. And then you have on the balance sheet, you have total financing, and what you're really doing is looking at the creditor financing and the owner financing and adding them together. So its total finance for Colgate was $12.724 billion for this particular period in time. Look at the income statement. You have both a gross profit and an operating profit. And what's going to happen is when you start looking at this relative to other businesses, you're going to look at it either on common size, or you might look at the gross profit percentage on a similar type of business. That's a big thing for you want to take a look at. And that's on the income statement, and that's sales less cost of goods sold gives you gross profit. And gross profit is less operating expenses, gives you operating profit. Those are key things to take a look at. And here's the financial statements for Colgate. And these are trended financial statements, is what you're going to have to do in your financial analysis. And the statement of cash flows, you have operating, investing, and financing. So there's three categories in the statement of cash flows. Each one of those has a different activity. The operating activity really is driven primarily off of the financial statements for the balance sheet. It's going to be current assets and current liabilities, and then you're picking up what the net income is. And what you're really doing is you're reconciling your income from an accrual basis to a cash basis. The investing activities are really going to be driven by long-term assets, and really long-term assets and what's happening with the business with long-term assets. And then the financing sections is going to be the long-term liabilities, and also the stock and retained earnings. And my apologies if you can't see the last part of this. You can refer to your text exhibit 1.8. And finally, the statement of retained earnings. I'm not going to go through a lot of this, but this just gives you a little bit of a picture about what's going on. The one thing I might point out is how much this business has in treasury stock. And remember, treasury stock is a contra equity account where they go out and buy stock out on the open market. It's either to give to their employees, or it might be to increase the value of their stock. And sometimes it's a good thing to see treasury stock on a company's balance sheet. So the next question: in which of the previous financial statements would an analyst find the investing, financing, and operating activities reflected? Well, it's pretty obvious. The statement of cash flow is the last one we looked at. So what we're doing from an analysis preview is we're going to do comparative analysis, trend analysis. And trend analysis helps you understand what's going on. A friend of mine runs a local burger place, and I was in his office one day when he was closing, and he got out a little notepad, and what he did is he wrote down what his sales were for the day. And he said, well, last year on this particular day, we made whatever the dollar amount was. Didn't matter. But what he is he's doing a trend analysis on a day-to-day basis to see if his business is doing better or worse on each day. And that's kind of what happens in a much grander scale when you're doing trend analysis or comparative analysis in the business, because you're trying to see what has happened year over year and what are the impacts on the business. That's where your analysis is going to be critical. So when you write up your analysis, one of the things you're going to see is, I'm not going to have you do the calculations. I'm going to provide you tools to do the calculations. The majority of what you're going to do is not the calculations. It's going to input information into a spreadsheet that will make the calculations for you. The critical piece you have to focus in on is the analysis. And you want to look at changes. So here's one simple example. They say, okay, so let's just look at the top example for just a second. And it says, well, their sales went from 15.6 billion to 16.7 billion. So they had a 7.5% increase in sales. Well, if you were analyzing this financial statements, you'd say, well, why did sales go up 7.5% year over year? Did they have a price increase? Did they sell more units? Did they open a new market? What happened? But what's interesting is, not only did their prices go up, they also had their costs go up even higher. So their gross margin or the gross profit actually went down on a percentage basis. That calculation isn't here, but I can guarantee if you took the 9.2 billion divided by 15.6 billion, the percentage compared to 9.6 billion divided by 16.7 billion would be different, just based off of how the numbers work. The gross profit percentage is going to go down. So what you want to do is look at each one of these line items and try and understand what happened within the business. First within the business, but then also maybe comparing it against their industry peers. So we can do also something called common size analysis. And what you're doing is you're restating the financial statements based on a percentage. So if we look at the assets, for example, from 2011, cash and equivalents was 6.9% of the total assets for the year. And if you look and you see here, we have a trend over the last 5 years, 6 years actually, that cash, that's the highest cash and cash equivalents balance that the company has ever had. You might say, well, what did they swap out? Well, it looks like their property, plant, and equipment is much lower. So maybe they sold off some stuff, and you might go back and look at their statement of cash flows. Because you see, you have 28.8% compared to the 30s for several years. So they might have had some property, plant, and equipment that they sold off and put some of it into cash. So there was a significant change, about a 5% change here, and there was about a 4.5, no, 2.5% change in the cash equivalents. So this common size gives you another tool to understand what has happened with the business. And now you have common size balance sheets. I mean, an income statement, and the same thing holds true. Well, so what this represents, like we were talking about earlier, the gross profit went down over not quite 2%, 1.8% year over year. Well, what has happened? I mean, it's a little bit of a disturbing trend if you think about it. They started off around 59. They're tracking around 59. All of a sudden, they go to 57.3. Something has changed in the business. That's something that you'd want to try and understand what has happened. And you'll look at these tools like the management discussion analysis, the competitive analysis, and all the other things that we touched on earlier to try and even what the notes in the financial statement, they will probably give you some insight into what caused the numbers to change drastically. And then we do some ratio analysis, and we're looking at different types of ratios, and we'll do financial statement analysis from that, and we'll get into more details with that later. And then how efficient and useful is the market information that is available? So we're going to look at that, the market efficiency. Weak form says that prices reflect information in past prices. Semi-strong says that they reflect all public information available. And strong says that they reflect all public and private information. So each one of those is different as far as the efficient market. And the efficient market is really talking about the value of the stock. How is the book? Let's talk just a second about how is the book designed. Well, this book design, the layout is as follows. And the chapters are a little bit off in this slide because this is from the publisher. But basically, we're doing 2 chapters of really kind of overview of financial statement analysis. And then we're going to talk about accounting analysis in these chapters and financial analysis in these chapters. And each one of them has a little bit different view behind it. And what you're going to see from a test perspective, if I remember, is we're going to go through accounting analysis. This part will be your first test, and this will be your second test. That's it for this chapter. I hope you have a great day, and I will see you in chapter 2. Thanks.